When you look at a big company, have you ever wondered how to really see what's going on inside? Well, it turns out they all have something like a report card. And that's what we're going to do today. We're going to figure out exactly how to read it.
So let's say you have some money to invest, right? You see a company, you love their product, and you're thinking, hey, maybe I should buy some stock. But how do you really know if they're healthy? I mean, are they a solid bet or are they teetering on the edge? That's the exact problem these financial statements are built to solve.
Okay, so first things first, why do these reports even exist? It's not just some old tradition, There's a really clear official reason for this whole corporate report card thing. And honestly, it all boils down to one simple idea: being useful.
And there you have it, right from the source. The whole point is to give useful financial info to investors, lenders, and, well, anyone else putting money into a company. It's all about helping them make better decisions. It's a tool, plain and simple.
And listen, this isn't just for Wall Street bigwigs. We're talking about everyday investors trying to decide, should I buy this stock? Or banks figuring out, should we give them a loan? Even suppliers use it. They all look at this same report card to make these huge financial calls and, to see if the people in charge are actually doing a good job with their money.
Okay, but for any of this to work, really work, the information has to be trustworthy, right? You just can't make good decisions with bad data. It's impossible. And that's why this whole system, the entire thing, is built on two, let's call them the two golden rules. They're non-negotiable.
And here they are: relevance and faithful representation. Just think of it like this. They're two sides of the same coin. One side asks, is this information actually helpful for making a decision? And the other side asks, is this information true? You've got to have both. One without the other is useless.
All right, let's break down that first one, relevance. The bottom line here is that the information just has to matter. Think back to a school report card. The grade for your art class might be interesting, but your calculus grade? That's what's relevant for an engineering scholarship. It's the same deal here. Financial reports have to focus on the stuff that can actually change someone's mind.
And what makes information relevant? Well, it does two really powerful things. First, it has predictive value. It helps you get a sense of where the company might be headed. And second, it has confirmatory value. It helps you look back and see if your past assumptions were right. So it's both a crystal ball and a rearview mirror.
Now, inside this idea of relevance is another super important concept called materiality. I like to think of this as the so what test. Basically, it means some info is just so big, so important that if you left it out or got it wrong, it would totally change how an investor sees the company. It's all about the size and impact.
And the difference can be huge. For example, nobody's going to dump their stock because the company spent an extra $50 on paper clips, right? That's just not material. But what about a giant lawsuit that could bankrupt the company? Oh yeah, that is absolutely material.
Okay, so that's golden rule number one, relevance. Now for rule number two, faithful representation. This one's pretty simple, actually. It's the honesty rule. The numbers have to tell the real story of what happened with the business, not just some technically legal but misleading version of it.
And to get that honest picture, you need three key ingredients. First, it's got to be complete. You can't leave out important details. Second, it's got to be neutral. No spinning the numbers to look good. And third, it's got to be free from error. The math has to be right. So, if you have information that's both relevant and honest, you've got a solid foundation. That's good. But what makes it great? Well, there are four more qualities that really take it to the next level. Think of them like the finishing touches that add extra polish. First up, comparability. This is huge. It means you can put this year's report card right next to last year's and see the trends. Are things getting better or worse? And even more, you can compare it to another company's report card to see how they stack up against the competition. It's all about that apples-to-apples comparison. Next, we have verifiability. This one's all about trust. It means that if two different smart people looked at the company's books, they'd both arrive at the same basic conclusion. It's like, showing your work on a math problem. It proves the answer is real, and you didn't just make it up.
Then there's timeliness. This one's a no-brainer. Old information is useless information. A report on last quarter's sales is helpful now. A report from 5 years ago, that's ancient history. For this stuff to matter, you need it while it's still fresh.
And last but definitely not least, understandability. Think about it. You could have the most accurate, relevant, timely information in the world, but if it's written in a way that only 3 people on the planet can understand, what good is it?
It's worthless. The point is to be clear, not to bury people in jargon. All right, that's a lot of rules and theory, I know. So let's bring this down to earth. How does this all play out in the real world? Let's look at a really simple, practical example to see how these rules get put into practice.
So picture this. There's a company, and they've got this huge warehouse just filled to the brim with inventory. But there's a big problem. All that stuff, it's obsolete. Think old tech or last season's fashion. Nobody wants it. It's basically worthless.
So here's the question for you. What does the company do? Do they get to keep listing that inventory on their financial statements at the high price they originally paid for it? Think about those golden rules we just talked about. What's the right move here?
The answer is a big, fat no. Absolutely not. Why? Because saying that inventory is still worth its original cost is just not true. It's not an honest picture of reality. It would make investors think the company is worth way more than it actually is, and that is a classic violation of faithful representation.
That inventory problem is a textbook case, but it's not the only thing to look out for. Other big red flags? Reports that are just crammed with useless, trivial data, or companies that are constantly changing how they do their accounting from one year to the next. That's usually a sign they're trying to hide something.
Okay, so let's tie this all together. What's the main takeaway? When you look at one of these reports, what's the most important thing to remember?
And here's why all this truly matters. This isn't just some boring accounting theory. These rules, they are the absolute foundation of trust. Without them, investors are just guessing in the dark. The whole system of getting money to the companies that need it would just fall apart.
So if you only take one thing away from all of this, let it be this: the two golden rules, relevance and faithful representation. At the end of the day, just ask yourself two questions. Is this information useful? And is it honest? Everything, and I mean everything, is built on that.
The rules seem pretty clear, right? But the real world of business is messy and complex. And that leaves us with a really important final thought. It's one thing to know the rules, but it's another thing entirely to have the judgment and the integrity to apply them correctly, especially when things get tough. And that, really, is where the challenge lies.